Most people think building a good credit score takes years. But the truth is, you can start improving your credit score in just a few months if you understand how the system actually works. And today, I'll show you exactly how credit scores are built, what really matters, and the fastest safe way to increase yours. Part 1. Why credit score matters. Your credit score is one of the most powerful financial numbers in your life. It affects whether you get approved for credit cards, car loans, mortgages, apartment rentals, and even some jobs. A higher credit score doesn't just mean approval. It means lower interest rates. For example, someone with excellent credit could pay thousands less in interest compared to someone with poor credit, even for the exact same loan. So improving your credit score isn't just about borrowing money. It's about paying less for everything. Part 2. How credit scores actually work. Many people try random tips online without understanding this part. Your credit score is mainly calculated using 5 factors. 1. Payment history to 35%. This is the most important factor. Do you pay your bills on time? Even one late payment can significantly damage your score. Payment history tells lenders one simple thing: can you be trusted? 2. Credit utilization to 30%. This measures how much of your available credit you're using. If your credit card limit is $1,000 and your balance is $800, you're using 80%. That signals risk. Experts recommend keeping utilization below 30% and ideally under 10% for faster growth. 3. Credit age minus 15%. The longer your accounts stay open, the better. Closing old credit cards can actually lower your score. Time builds trust. 4. Credit mix to 10%. Having different types of credit helps. Credit cards, loans, installment payments. It shows you can manage different financial responsibilities. 5. New credit inquiries minus 10%. Applying for too many accounts in a short period signals financial stress. Each application slightly lowers your score temporarily. Part 3. Fastest way to build credit. Now let's talk strategy. Step 1. Get your first credit card. If you're starting from zero, begin with a beginner credit card or a secured credit card. Use it for small expenses only. Gas, subscriptions, or groceries are perfect. Step 2. Never miss a payment. Set automatic payments. One missed payment can stay on your credit report for years. Consistency beats everything. Step 3. Use credit. Don't max it. This is where most people fail. Using your card helps your score. Maxing it hurts your score. The goal is activity, not debt. Step 4. Pay before statement date advance tip. Most people don't know this. Banks report your balance before your due date. If you pay part of your balance early, your reported utilization drops and your score can increase faster. Step 5. Keep old accounts open. Even if you don't use a card often, older accounts increase average credit age. Just make a small purchase occasionally. Part 4. Biggest credit score mistakes. Avoid these common mistakes closing your oldest credit card, missing payments by a few days, applying for many cards quickly, carrying high balances month after month, only paying minimum payments. Remember, credit cards are tools. Part 5, Real Example. Let's look at a real example. Imagine two people starting with the exact same credit score. Both have a score of 650. Person A uses their credit card normally, but keeps a high balance, around 80% utilization, and only pays the minimum every month. Person B uses their credit card for small purchases and keeps utilization below 10% while paying the balance early. After 6 months, Person A's score down or hold. But Person B could see an increase of 80 points. Not because they earn more money, but because they understand how credit behavior is reported. Credit scores reward habits, not income. Part 6. What banks don't tell you. Here's something most banks never clearly explain. Your credit score doesn't measure how rich you are. It measures how predictable you are as a borrower. Someone earning $40,000 per year can have a higher credit score than someone earning $150,000. Why? Because consistency matters more than income. Lack of payments, aggy balances, and frequent applications signal risk, regardless of salary. Understanding this changes how you use credit forever. Part 7, 90-Day Action Plan. If you want to start improving your credit score today, here's a simple 90-day plan. Month 1. Check your credit report and set automatic payments. Month 2. Lower your credit utilization below 30%, ideally under 10%. Month 3. Avoid new applications and maintain perfect payment history. Small, consistent actions over 90 days can create measurable improvement. Credit building is not about tricks. It's about repeatable habits. Part 8. Realistic timeline. If you follow these steps, in 3 months improvement, in 6 months strong breeze, in 12 months, gives good credit profile. Building credit is less about speed and more about consistency. A good credit score isn't built by luck, it's built by habits. If you want to learn how to avoid debt, use credit cards correctly, and take control of your finances, subscribe and follow the channel. Because the next mistake most people make with credit cards keeps them paying interest for years.